Lexi and Carrie, welcome to Get Shit Done. Or actually, Carrie, welcome back.
I'm here. I'm thrilled
Hi.
to be here. And with Lexi,
Yeah.
thrilled. I'm
This
in the
is
presence of royalty.
this
Nice to see you both.
exactly.
Yeah.
This is acquisition, sell your company, royalty right here. I'm very excited. But before we get into this deep dive today, because I know so many founders, like we hear about acquisitions and selling companies, and like it sounds really cool, but also like I don't think most people understand what that means. I think people are like, "Oh, you IPO." I'm like, most companies are not going to IPO. So what are those paths? But before we get dig in, I would love for you all to briefly introduce yourself so the audience understands kind of the context of where you're coming from. So, Lexi, we'll start with you.
Sure. Yeah. I'm Lexi Grant. I run They Got Acquired. We're a media company and we help founders sell their business. So my background is in running media companies. And I went through it twice and felt like both times, like, who do I ask for help? What am I doing? Like, are there other people like me out there who have sold smaller businesses? And that's why I started They Got Acquired. So primarily we help founders with by providing like free information, education around how to build a business that you can sell.
I love this. Also, I do not subscribe to a lot of newsletters. As yours is like one of five that I
Aw,
actually subscribe
thank
to
you. That's
because
cool.
I think we all know there's just so much content, and I'm like, I can't have things in my business inbox, but there's select few that I actually will, and they got acquired. It's
Awesome.
definitely one of them. And Carrie, welcome back. Let's introduce
Thank
you,
you.
reintroduce you.
Thank you. And I will say there's some very interesting commonalities for me and Lexi because I think with Lexi, she like really captured something that nobody was articulating well because when we highlighted acquisitions, you saw it where in TechCrunch or like, these huge exits, which by the way, you have no idea how much the founder actually gets.
No, it's all
And,
bullshit.
right. And she figured out very quickly that lots of acquisitions don't happen like that because she lived it. And so she started this media company that, I mean, that newsletter, I was just on a podcast and they were like, well, the go-to newsletter
Aw,
everybody needs to read is They Got Acquired. Like just all of that to say, Lexi tapped into a real niche, and I similarly really focused on a very specific niche based on an insight, which was that I was going to work with female founders to help them get exit ready because of the data that we have around exits, unfortunately, it shows that two things: women are exiting for less, which is an easier one to explain because they raise less money and therefore have less larger exits. But really, they're exiting their companies less through a transaction. So, in other words, many of them just don't even realize that it's an option. And so, I help founders more on the coaching side. I match female founders with women who have been in their space, sold a business like theirs to help them get ready. And of course, that has been a fantastic journey that has been helped by people like Lexi who are getting the word out about how important this is.
Yes, absolutely. And I'm grateful because Carrie reached out to me a couple years ago and she's like, we absolutely need to talk. And, we both talk about the stats around women entrepreneurship. Years I didn't actually know around the low exit rate. What is it?
The exit gap, yeah,
0.8%.
28,
Yeah. Of women exit their
0.8%.
businesses. There's
Yeah.
such a small group of us. And
Yep.
then only 1.7% of us ever get beyond a million. And so that's why I'm like, okay, this conversation needs to happen. So now you all know we have the perfect people to talk about selling your company and getting it acquired. But now I want to dive into what do founders, in your opinion, get wrong about business acquisitions?
Who you want to take it first, Lex or me?
go for it.
Oh my God. The first thing that they get wrong is well, there's lots of things. There's things they get right too, but it's overvaluing your business. Almost always the reason a business doesn't sell is because of unreasonable founder expectations, because you pour your blood, sweat, and tears into that business and you feel like this has intrinsic value. The sweat equity that you've built in this business, like of course it should be worth something. Isn't it worth something? And in reality, a business that is acquired is a business transaction, and it's most often valued off of the EBITDA that you produce. And so I think one of the mistakes is one, not getting educated about how this works, and two, is not realizing that profit is extremely, extremely important and not selfish, especially for women. We pour everything into our business. We say, oh, we'll worry about us later, worry about the profit later. Let's just take care of everything and get it done. You need to, at the very least, after you've begun, really have a model for profitability that makes sense to an acquirer so they can see how they would make money.
Yes, and this is actually what I love about I saw a post of yours, Lexi, like maybe a couple of weeks ago, where you're like, and we'll get more into this later, but like VC valuations around exits are smoke and mirrors. But if you're going the other path, what we'll talk about later, like it's not, there has to be value in terms of dollars and cents. So I love that you mentioned that, Carrie. So what do you think founders get wrong, Lexi?
Yeah, I mean, that is the number one. I think a lot of founders think, oh, it's going to be about my revenue. Sometimes that's especially true if they come from a VC background, but even bootstrap founders sometimes have that misconception because we hear so much chatter from Silicon Valley. And revenue is interesting, but profit is really what matters. The other thing I see is founders like not thinking about this until they're so burnt out, like burnt to a crisp, and they're so desperate to get out. And then that doesn't leave you with very many options. Like if you're thinking about it early, you can think about how do I optimize this business so I can sell for as much as possible. And you're giving yourself more options and more um, coming from a position of strength. And if you're coming to that sale when you're burnt out, like if that's where you are, that's okay. You can still sell, absolutely. But it's better in ideal world. You think about it earlier.
Yes, I love this. And I want to dig into what are the options for founders? So, all my VC friends, hey, you guys know I always give you shit about this, but I think we have created a warped generation of founders who think success and scale is synonymous with VC. And as shitty as these markets are to raise capital, I'm really actually happy we're here. And I mean that's probably a hot take, but it's also we've created, the horizon of 10 years. VCs or investors are looking at the returns they got on these stupid valuations, and a lot of people lost. Founders, funders, everybody lost. So instead of us just focusing on your VC-backed company and then you grow really big and IPO, what are the different paths that founders can be thinking about when they think about getting acquired or selling their business? What are some that you all and also the ones that I feel like people aren't maybe considering?
Lexi, what
Well,
do you think? You
I
go
mean,
first.
this is like a big passion of mine. Like the biggest thing is like small exits can be life-changing and meaningful, even a
Yes.
six-figure exit. Like you could have a couple of smaller exits and you invest that money and you're set. Like it adds up over time. I think people think I have to sell for 8 or 9 figures to like really win this. And that's just not how a lot of founders are doing it. So, if you have a chance to have a win when you're young too, and it's some people will say, hey, I don't want to sell this business until I can sell for 10 million. I'm like, wait a minute. If you're young and you sell it for 2 million and you put that money away, you've got a long time for that invested money to grow. So there's more than one way to do it. And I think that's one that people do overlook.
Okay,
Yeah,
so I'm gonna add to that for her because this is fascinating actually about my own exit. I'll give it to you here first and how we did it. So
I
I
love
sold in
it.
2021. I sold for 8 figures. I was not actually at the height of what I could do. Like I was there and I was growing. I had a little more growing to do. In the first year after I exited and I grew more, I thought to myself, oh, I should have sold, I should have waited to sell. I should have waited to sell. Had I waited to sell in the following year was when like social media agencies totally started to change and AI came
Mhm.
in and revenue became much more compressed. Had I waited, I would have actually been in a lot more trouble or taken out a lot less value than I would have had I done it just in the moment. So Lexi's point about like you don't have to wait until you hit some arbitrary goal so that you hit some arbitrary level of wealth. Like it's the idea is that businesses and business sales, and I love this, what Lexi said, they're stackable. In other words, you can build a business and sell, go on, put some money away, invest a little in a new business, and do it again. And I think people think I need to sell a business to retire. But the reality is no, but everybody, I always say this, acquired, not retired. Nobody is actually ever really that done unless you're really at retirement age. People want to build again. They might want a slower lifestyle or something different, but once you build, you find you want to do it again and again and again.
Yeah.
In terms of alternative exits that you mentioned, you can sell to employees. You can recapitalize and find a business partner, bring them in, extract some money, take money off the table and help phase them into it. You can merge with another company that is your competitor. There are so many options that aren't just sell to PE or, go to a big holding. There are many, many alternatives to this. And so
Yeah.
just think outside the box.
Yeah. And I would love to actually go deeper into that because what are those different paths that maybe are not getting highlighted enough, but are really viable paths? So for you, Carrie, you sold your business, you sold it to kind of complementary competitor,
It
which
was
is
considered a
amazing.
strategic, yeah.
Yeah, it's very strategic. So I would love for both of you to dive into it. And so let's actually start with Lexi on this from even what you do with they got acquired. What are some of like the paths that you're like are consistently coming up for selling your company? Who are those players? And then Carrie would love to hear from you too, from the ones you're saying that there's so many different options.
Yeah, I mean, I think one that is out there a lot that people don't really understand until they get to it is an acqui-hire, which
Mhm.
is when a company buys your company primarily for the team. So you're part of that. And that was what when I sold I had a small content agency that I sold in 2015 and that was an acqui-hire. So I went in-house with the buyer and helped them grow their operation there. Um, I think often acqui-hires are seen as like a last ditch resort. And certainly sometimes they are. Like sometimes, and actually, for a lot of VC backed firms that run out of money, they might be bought by a company that wants their developers or wants something about the team and hoping the team can give them value inside of their own business. But it's a great option too for even people who are not in a bad spot, especially if the founder wants to keep building. Like, not every founder wants to completely exit when they sell their business. Some founders, especially if they're smart about it, they have gas left in the tank and they may want to keep contributing, or maybe they want to get what's called like a second bite at the apple, where their buyer then grows the business and then sells again. If you're still part of that, you can get a second payday. So there's lots of different ways to kind of structure or think about whether you continue on with the buyer.
Yeah, this reminds me of I mean, my friend Corbett Drummy at Popular Pays, they were an acqui-hire, Wethos, Rachel Rennock, like there's so many. And I think again, it's like the smoke and mirrors of you got an IPO, and I'm just like, do you want like people don't understand the insanity of going that big. And I'm like, mostly by ask founders, I'm like, do you want that life? I don't think you understand like the consequences, especially I'm like in my 20s, I think I thought, okay, we could get there and I would never want to run an IPO'd company. But now I'm like, nah, that's no, there's other ways to build wealth. And Carrie, what are some other alternative paths for founders when they're thinking about who potential acquirers could be?
Well, two things. One, you bring up a good point on like there's more than one way and like are you sure you want to do this? Thinking about why you would want to build a VC company, if you got funded fast, behemoth, huge, and your exit. Like if it's for money, you don't always make that much money. I just had a podcast yesterday where I was interviewing
Yep.
somebody who had a business that sold to a strategic for 9 figures. She was the solo founder and she came out with almost nothing. And so the idea being, if you want to build a behemoth, think about why. If you want to build a business that makes you happy and helps you extract profits and then gets to a space where you sell, what Lexi talked about with the acqui-hire is actually so interesting because I agree with you that acqui-hire, so an acqui-hire is I've run a business, I've taken it as far as I can go on my own, I'm going to join with somebody else, they're going to take on my team, take on my salary. And most people think, well, that's it. And okay, so I'm basically selling for a job. But what Lexi said is true. You can negotiate for upside, you can negotiate for equity, you can negotiate for a lot of things in those types of smaller acquisitions. The other thing, the other type of exit that I think people don't think about a lot because they don't think it's possible is a sale to a partner or employee. You think about an employee and you think they could never, ever afford that business. But if you recapitalize your business, in other words, you take a loan out on the business, you extract that value, you bet on that founder, your other employee, and they pay it back through the profits of the business and then some. There are many feasible ways that employees or partners can buy you out over time using the profit of the business. So you have to think about what you want and when. So that's like just one option. I mean, you can go out and search for a strategic buyer, and a strategic buyer is somebody who's going to buy you because they think one, your company plus one, their company equals three, right? It could make more money than the two are making on their own. And so they'll pay you like an inflated value for that in some way. You can go to a financial buyer. A financial buyer is usually like a PE firm or somebody who's like going to compress your profits as much as possible. They project on that. And then they'll say, okay, we'll pay you off of that. It's usually like private equity. But there are the other options like an acqui-hire, like selling to an employee, like finding an individual buyer. Do you know how many search firms are out there right now? So people are handing entrepreneurs money, like a person, and saying, go find me three businesses to buy. We'll buy them. And then you have all of them combined are worth more than the individuals as a whole. We can talk about that too.
Yeah.
But that's another option. It's just expand, learn, read Lexi's newsletter all day, and she'll tell you a
Yes.
story they'll give you.
Yes. And I love it, especially like when you're rolling up. I mean, a lot of these big companies aren't do it. Like, for example, I always say like Facebook, Meta, whatever you want to call it these days, is really not that innovative. What they do is just acquire stuff. And I'm like, it works well. They're performing very well in the stock market because they're just like, it is more expensive for them to try to figure it out themselves. That is not their specialty. It is finding the really good talent. I think there's something right now where he's even just on talent, he's spending like hundreds of millions of dollars for AI, right? So there's so many different companies out there that want to be a part of this.
I thought of another one. Lexi, tell me if you've seen this.
Mhm.
Sometimes there's another way to do if you don't have a lot of money and you want to come together. Sometimes you can form like a collective where no equity is actually exchanged. So you say it's almost like a virtual merger, right?
Yeah.
Five companies come together to form one for when it's time to sell. So you agree you're going to package up and sell together. You operate independently as a whole and you're individual, and then you have like a little bit of shared services in there that you all contribute towards. That
Mm.
improves everyone's EBITDA. And by the way, or profits, if you, for those of you who don't know what EBITDA is. And then the other interesting piece of that is what we call multiple arbitrage. So like a smaller business might be worth 2 to 4 times your profits, but a bigger business might be worth, with more money, you pay more for it because it's more valuable, might be worth 5 to 7. So if you all come together to package, you're worth a higher amount and you're worth more than you would ever be. You could find a group to do that too. There's all kinds of interesting things. Just to bring up alternates, since I know this is a deep dive and we want to give you like every possible thing, I thought of
Yeah. No, I love this. I love this. So we talked about the different factors, well, the main factor here of what attracts an acquire. A lot of times it seems like it's profit or the team. What do you all feel like when there's a healthy acquisition are the top metrics that an acquirer looks for that founders really need to be, if they're considering an exit, they need to be really keeping top of mind? And Lexi, we'll start with you.
Yeah, I mean, the first one is obvious. It's just like having a great foundation of a good business, and profit is a big part of that. Having a team that can run the business with ideally without you, like having low founder dependency, so there's not a founder key man risk there. And then the other piece is something that Carrie actually brought up, which is you want to sell when you're growing. And a lot of people don't know about this either. Like this can drastically increase your sale multiple. So if you have two companies that look the same in every other way, but one of them has a great growth trajectory over the last few years, that's going to get a much higher sale multiple. And so the way this plays in practice is you want to sell your company before you have actually reached peak, which is what Carrie said she did. And it feels counterintuitive because many of us want to like ride that wave as long as we can and meet our potential, maybe even just for internal satisfaction. But if you sell while you're still growing, you're likely going to get more money for the business.
And Lexi, when you say like growing, what are some of those markers? Because people could be like, we're growing, and like an acquirer might be like, that's not enough, right? So it's
Mhm.
kind of like when a VC tells a founder, you need more traction, they're like, tell me more. Like so when you think of like those triggers of like you're in a great position, growth position now to go have those conversations, what have you seen be some of those appealing moments?
Well, it's really comes down to profit. I mean, you can look at, there's lots of metrics you can look at, and you want them all to be trending in the right direction, but the biggest one is profit. Another thing you could layer on top is like whether your revenue is recurring or not. So if you have one business that is on a profit, they make money on a project basis. So they're making money, they have to go out and get that business, win it every time, or one-time sales. Compare that to a recurring revenue business, and it's just going to get a lot more money for the sale. That's why software companies tend to have really high sale multiples because many of them have recurring revenue.
Yeah, I mean, we're hearing this right now. I was just listening to the journal on this, like Larry Ellison becoming like the richest man for like a few moments
Yeah.
because
Yes.
of like their earnings call and like how much AI, but these are recurring models, Salesforce, like all of them are recurring revenue streams that are, I mean, it's revenue that you can expect versus to your point, a lot of founders are in this start and stop. I need to go and try to find the capital, bring it in, and there's nothing wrong with that, but it does make it harder to plan because you can't say like this is going to happen or not.
Yeah.
Because I mean, COVID could happen.
Mhm.
The markets crash, who knows? But Carrie, are there any other metrics that you think founders should be really considering to, as they're considering an exit, that needs to be top of mind?
I mean, Lexi hit the most of them really, really well. I would
Mhm.
say on the recurring piece, I have a very, very simple acronym. I like think and speak in acronyms. Keep your revenue red. Recurring, expected, so you can forecast it and project growth, so you can be sold on growth, and diversified. Don't put
Mhm.
all eggs in one basket, either of one product, of one client, of one retailer, whatever your business is, just make sure that you have a diversification so that if one thing shits the bed, you've got other stuff there. So I think recurring, expected, diversified. I think Lexi's absolutely right about profit. If you can show that every year you're making more money without sacrificing retention of clients, of products, of sales, you are really in a great space. Show me every year you're making more money while you are continuing to maintain and grow the business. I'd rather see a business with relatively flat revenue growing their profits than a business that is growing their revenue and then their profit percentage is decreasing by a lot. I want to show that with every dollar you add to the business of revenue, you are also able to add profit. The scale, the economy of scale needs to work. And by the way, if you're not a VC funded company and you're a bootstrap company, founders, acquirers rather, are not expecting rocket ship growth. Like if you have rocket ship growth, that's great. It's just show you're growing. Like there's no percentage that really matters. You just want to show you're not on the decline and that every year there's more and more interest of some sort. And I think the time to show that you've got a really steady history of growth. This, I don't know what you think on this, Lexi. I'm curious. I think 3 years of growth is really strong, and 2 years of growth is good, and 1 year of growth, it depends on the history before. If there was a fluke, if there was, I think you need multiple growth to really get that growth attribution, unless you unlocked something huge that you can articulate in an interesting way.
Yeah, and the other thing that I like to point out here that's actually really cool is if you think about what makes a business attractive to a buyer, it's pretty much all the same things that make it attractive for you to run it as a business owner. Like if you're making good profits, that's great for you as a business owner. If you have a team that you've delegated to and the whole business doesn't revolve around you, that's great as a business owner. The only one that's tricky here, I think, for bootstrap founders is growth. Because like I know if I'm running a business that's consistent year over year, I don't feel like I necessarily have to grow to feel good about it. Like if I'm enjoying what I'm doing, I'm making, healthy money, I like the work. I don't have to have growth to feel fulfilled. So that's the one piece that I think is like a little bit different between like what the business owner needs to have versus what the business owner wants versus what the acquirer wants. Generally speaking, it's almost one and the same.
And you
Yeah.
know what though? I'll tell you one thing on that, Alex, just so you have it. Like that business that Lexi just described, I'm a founder. I've built it. It's steady for years. That's also good because acquirers are lazy. They don't want to do, like if you show me a good business that's steady every year and it's predictable, that's high on the expected part of that equation. You can sell that business for sure. On that business, you're going to look extra hard for founder dependency. On that business, you're going to say, okay, is that expected because it's Lexi or Carrie, or is that expected because the model is sound? And so that's important. So it's a great distinction.
Yes, and I love this, especially around the math piece. I think a lot of founders, we hear these really big, fancy, buzzy words like get acquired, sell, and people just don't understand what's behind that. So I love how you both broke it down. So now I want to get into, we know here are the things that our acquirers are looking about. We talked about the different types of acquire. How can a founder decide for themselves? Like, what is a practice they could do to be like, what path is best for me? And to Lexi's point earlier, sometimes you might not have the decision. Like you might just be in a position where it's like this is what, beggars can't be choosers. But let's just assume you're a type of business that's really in a good position to pick your path. How should they decide? What should that narrative look like for the founder so they are going down the path an acquisition partner that would make the most sense for their vision of success?
I guess I'll take this one to start. If you look at so Whisper Group is my company, and Whisper is an acronym that stands for the seven tenets of building a highly sellable business. And the first one is W, which is why. I think it's really important to, before you get into any of these conversations, understand why you might be thinking about or want to sell. Do you have a number in your mind that you need to extract to go into your next venture? Do you need to pay for your kids' college? Do you want to be a part of something bigger? Are you exhausted and feeling like you need a partner to help take this to the next level? Do you want to just be done? When you get clear on the why and really understand the why is when you go into the H, which is how. And that is, I want to understand the multiples in my industry. So you go straight to theygotacquired.com and you understand those amazing reports she has. And you take a look at the different types of acquirers and you look at people in your industry who have sold and you look at the different paths. You start listening to your show or my show or read Lexi's stuff, like, and you start looking and then you see which most appeals. And for every person, that's different based on their why. So that's how I would answer that.
What about you, Lexi?
Yeah, I love the focus that Carrie always puts on the why because I think it's really important and also uh, under underestimated, I guess. Like people just they're thinking more about, hey, how do I get to the end of this and not like what do I want at the end? Like besides the money, like why are you doing this? Um, so I think after you do that work, the more you can stay open-minded to different opportunities, the better. Because it's impossible to know when you before you bring your company to market all of the potential buyers that might come to you. You can make guesses. But this is why like it doesn't usually make sense to say, oh, I think I'm going to have this buyer, and so I'm going to change the company in this way, to make it more attractive to that buyer, because in the end, a different buyer might actually be better. And you might be presented with opportunities that you didn't expect or you couldn't have guessed. And the more open you are, the more options you're going to have because
Yeah.
you might say, I don't really want to stay on, but then hey, you get an offer from a buyer who you really end up liking and you want to work with them. I mean, when I sold my first business, I never expected to become an employee again, which is what happened through my acqui-hire. Freaking loved it. It was amazing. I got to scale a business much bigger than I would have done myself. And that was not on my radar. So I think positioning yourself as best you can gives you the options. And then if you can stay open-minded, hopefully you'll have a lot of choices.
I love this point around openness because I realized too in the past couple of years how rigid I was in certain things. And then I started, even as an individual and a human, I started growing out of certain things. Like I mentioned, I'm like, I don't want to build $1 billion company. That's not interesting to me anymore. Because I'm like, I want a life. I'm in my 30s now. Like I want a soft life.
Hallelujah.
Like
Absolutely.
that's not interesting to me anymore. But I think to your point around being open, I think that's super important. So when it comes to being open, I would love to hear from both of you on this is okay, a founder is like, okay, I think we have some steady growth here. I think our profits are really, really legit right now. How in the heck do they put themselves out there? Who do they talk to kind of one, keep the door open and see what the options are, but what are those paths? Who are those people?
Lexi, you start.
Yeah, I mean, I think both Carrie and I are great resources. Come to us. I mean,
Yep.
so this is what we do if they got acquired. I do a lot of free calls with founders who want to sell and help them figure out what their options are. The main way that we make money is we connect founders who want to sell with M&A advisors who have experience selling their type of business and who have been recommended by other founders. So since we've written so many stories about founders that have sold, we've heard a lot of feedback about who they worked with, which professionals they engaged, and we use that to create our recommended list. And so we also just have tons of free resources. It's not always easy to find what you need, which is I say, like, if you need something, just ask me and I can point you towards the right resource. But yeah, we love helping founders. This is what we do. And I know this is exactly what Carrie does too. And Carrie, you know what is cool is I'd say around 4 years ago when I started this business, people always used to say, have you heard of so and so? I won't name the person. It was a man who wasn't in M&A. And I'd say, yes, we're different from them. We're not the same. Anyways, fast forward to now, people say, have you heard of Carrie at the Whisper Group? And I'm like, yes, I
She literally made a
have.
post. She
So
was
I'm
like,
like, yay,
we're
now it's a woman who
friends.
people are asking about. Yes.
wait, this was my favorite post. Lexi made a post that was like, I'm looking for women in M&A. By the way, yes, I know Carrie Kerpen.
Yes.
I was like, I
There's like a
made
few
it.
people like that where I'm like,
I
yes, I know
made
them. I
it.
know. Yeah.
I know. Shut up already. Yes. So, okay. So let me give you a little bit outside of us too. So I do the work right now where the Whisper Group is like pre-readiness. Okay. So this is like, I want you to think about the steps you need to take to get valuable. Or you come to me and you say, I'm really, really stuck, help me. And, and we'll do that. And the Whisper Group is evolving and growing over time and all kinds of great stuff. But I think your question could be around like, okay, I'm ready to go. Who do I hire? And I have a couple of thoughts on this. So, like, just to give you, there's a few ways to do it. If you're a giant, you're going with an investment bank, but let's throw that out the window for a minute because most people we're talking to not
They're
going to
not going to do
really,
it.
no, they're not, they're not. Okay.
Yes.
So, what's a broker? What's an M&A advisor? And then, can you do this on your own? I'm going to answer those three. And Lexi, if you want to weigh in on this, on addition, because you have so much experience with this, I'd love it. Okay. A broker is somebody who's similar to a real estate transaction, is going to gussy up, send you out to everyone they know and their list and everywhere and put you up and, say you're worth this and help negotiate it for you. They typically take a percentage of your cash at sale, and sometimes they charge a retainer as a basis. What's the difference between an M&A advisor and a broker? I say ego, just what you call yourself, because an M&A advisor is the same damn thing. The only difference is, so like I do some M&A advising and that's like flat fee. I'm not taking a percentage of your exit because I don't believe in that point. I want to like just really help you through that process. I'll do it on an hourly or whatever. There are people who do that. It's fewer because where the real money is for brokerage most of the time is the percentage and the betting on the founder. And the reason they need to do that, by the way, just so you know, when you think like, why is this so expensive? 50% of deals don't close. Like these people do all of this work and then they don't close. And so it's for a number of reasons. Some are from the founder, some are from the seller, the buyer. It could go, a million different ways. So representation is helpful because you have someone negotiating for you. You have somebody who understands the market. All of those things are good. The question that I get every day is, can I do this on my own? And the real answer on that is you should always be talking with and networking with potential acquirers early. Why? because even if you work with a broker, then you say, I'd like a carve out or a lower fee for people who I already know and have networked with. And then also you're building the relationships and credibility and getting on their radar. I think that's really important. Now, if you're a small business and you don't want to pay a broker or you can't afford to pay a broker and you're saying, Carrie, Lexi, we can't do this. We don't, yeah. Yes, you can do it on your own, but you need a circle, a tribe, group of people, advisors, people who believe in you, who understand this to talk through some of this stuff. And, the Whisper Group offers that. You could literally go on intro.com and have people help you with that. There's like lots and lots of people in the universe, your own board of advisors, if you have it, your sister, somebody who's been through this before, like who you can talk to, because the reality is, this is a very big decision. Even if it's a six-figure decision, is huge freaking
Huge.
identity decision. It's a life decision. So just if you're going on it on your own, all that to say is make sure you have a circle that you can trust.
And I think in general, we saw this in 2020. We see this whenever there's a lot of uncertainty. I find founders isolate because we have a sense of like shame around things if things aren't going well, or we feel like we have to know everything. But these, in any moment, you should be leaning into your network, and which is just your community, and expanding that, because there's so many people out there that do want to help constantly. Like the amount of founders I've reached out to just randomly, like, hey, I would love to get your feedback on this. I'm going into this type of deal. I've seen that you've done it. It's new to me. And they're like, yeah, let's hop on a call. There's so many people that are open to that. So I love that you mentioned this. And we've talked about, okay, here are the different types of acquirers, and here's how you can get it done and who can help you. Now we're at the actual negotiating table. Where can founders fuck it up? What are the most common ways founders fuck up at the table where an acquirer is like, I'm out? So Lexi, let's start with you.
Yeah, I can think of a few. One relates to the question of can you do this by yourself? Because I agree with what Carrie said. I wish more founders would think about hiring help, which is why we help people do that. Because too often I'm seeing people who don't want to pay those fees, and then they try to do it themselves, and they could have got a better outcome if they had someone helping them. To the point where I think it can even make up for the fees. But the biggest piece there is like often founders who do it themselves, they try to find one buyer. And you always want to have more than one buyer. Like the best way to drive up your sale price is to have more than one person or company who's interested in buying the company. That gives you leverage. And if you can do that by yourself, that's amazing. If you need someone to help you, that might be the case too. It's hard to find people to buy the business, right? It's hard enough to get one. But that's, I think, one of the biggest mistakes. And sometimes it does make sense to sell to the first person who knocks on your door. Sometimes there's a strategic opportunity where they're going to pay so much more than anyone else would anyways. So you should absolutely sell to them. But on the other hand, sometimes you do want to get other offers in the mix. And I think too often founders say like, hey, oh, I'll just sell to this person. I'm like, oh, do you want to run a full process? Which means like, do you want to get other people interested? Do you want to take it to market? And maybe you eventually sell to that one person who came to you first, but you sell them for a higher number because there's other people who help push their sale price up. So that's one. The second I would think is around maybe earnouts. And Carrie can probably talk about this too, but a lot of sales have earnouts where you have to stick around and help the buyer achieve certain milestones before you get your full payout. And I think that is an absolute hazard zone where you want to have someone help you figure out how is this structured. As much as possible, you want it to be structured in a way where like you control the variables. So if, for example, your earnout is based on profit, but you're no longer in charge of how much money is brought in or how much is spent, like you don't have control over whether you meet those or not. So I think that's a really tricky part. And whenever we hear about acquisitions, when we do know the number, we usually hear like the top level, oh, this is how much they sold for. Well, like a lot of that could be caught up in an earnout, and founders often don't get their full earnouts. Like it's very, very common. Sometimes it's because they don't hit the milestones. Other times it's because they walk away because they just can't stand to work with the buyer anymore. But it's pretty common that you don't get that money. And so the only money that you can really count on is the money you get paid when the deal actually closes.
I love this, and I want to hear from you, Carrie, on this, but also Lexi, I want to dive a little bit more on that. How how can founders make sure that they are protecting themselves? Because there are a lot of people that don't get the full payout. Um, how can they be protecting themselves?
Well, the best way is to structure your company so you don't have to have an earnout. And the reason I said Carrie might know about this is because she mostly focuses on agencies. She grew an agency, and agency is the most common type of business, at least for the founders that we serve, that has earnouts. Um, Other companies sometimes do as well, but in agencies, you almost always have an earnout. We did write one story about a founder who had delegated so well to her team that she exited without any earnout because they didn't need her to run the business. But
That's
that's the
amazing.
basic part is like you've got to create an engine that runs without you. If it can run without you and you can prove that, then you won't be needed, you know, after the sale. So
Yes,
that's the best way to lower your risk or like and that makes the business more appealing too. And a buyer's going to pay more for that as well.
absolutely. And Carrie, you actually did an earnout, so would love to hear your
I'll
thoughts
tell you
on
all
this.
about it. I'll tell you all about it. But by the way, the reason a lot of times deals don't close once you get like a letter of intent. So here are the things where deals don't happen, which was your first question. One, an LOI, a letter of intent, which is what you get when somebody wants to buy your business, is not clear enough. And you haven't negotiated every detail. And then you start to negotiate the details as you're going through due diligence, and you find out that you and the buyer are not aligned. So, number one, get every single thing you care about in that LOI. And number two, ask every question on things you don't understand. I did not understand. I had been in business for 14 years. I did not understand what working capital was or how it was truly calculated. And that was a disadvantage to me because I didn't really ask. It was fine, but I didn't ask enough questions. And then I felt dumb. Like when I was like, oh, what do you mean? I have to actually give them back money. It's a very complicated calculation. That's annoying. And you should get to understand it when you're going through it. But now let's go to earnouts for a second. What Lexi said is absolutely true. So the reason, think about it from a buyer perspective. A buyer is buying something like an agency or a consulting group, right? Anything like that. Your revenue is recurring, but you have annual contracts. So you have annual contracts. You know your founder is not going to stick around forever. What's any reassurance that an acquirer has that those contracts are going to renew? What if those contracts just love Carrie Kerpen and don't really care about the agency, and the second she's out, they're out? That's a real risk for an acquirer. So just to put it in their shoes, like that's real. So what they do is they say, okay, we'll give you half up front or a certain percent up front, and then the rest, as long as the clients stay and you continue to make sure that that revenue is steady, we'll pay you on that. Or if you grow the business, we'll pay you oodles of money, okay? And that earn out, okay? So that's what an earnout kind of is. And what Lexi said, she nailed it. When you have an earnout, whether it is based on revenue or EBITDA earnings, you want to make sure that you have control over what you're being measured on. Because let's say it's revenue, and let's say I have an agency and I sell to a company that does social media for B2B companies, and I have a great client that comes in the door, new business, wonderful. They do B2B and B2C both. No, we don't want to take that brand. It's not the right fit for us. They could completely block me from getting that earn out because they say it's not the right fit. Same thing with profit. I'm running my business. I'm measured on EBITDA. I've always operated at 22% EBITDA or profit. Great. All of a sudden, they want to introduce shared services. They want to invest in marketing. They need to hire a PR firm to talk about the acquisition. Well, whose bottom line is that going to affect and how? The way that I recommend for founders, and it is hard to do, if a company wants to pay you on earnout as an agency, fine. You will operate on a separate P&L during the time of that earnout, and you have control over that P&L, and you can integrate as companies, but you will be measured on a P&L that you can control. And if not, don't do the earnout or be very, very careful. It's really important. Or assume that the earnout is upside. That's another thing you can do. Assume the
Mm,
earnout's a maybe.
yes.
Yeah, I like that
Yes.
approach because
Real
even if you do this to a T, there's going to be something that surprises you. And I think that actually, if you expect that, you will be less disappointed. Like this happened to me when I sold. I've seen lots of founders go through this where they're like, wait a minute, I didn't really understand or I didn't expect them to do it this way. And there's always some like loophole or something that was, different than what you expected. And I think it's almost impossible to completely avoid that. So just tightening it as much as you can, and then knowing there's probably going to be somewhere where it's not going to be perfect. And so you've got to feel really good about what you get paid, when the deal closes.
I love this. And it makes me think of red flags where you're like, red flag on the field, walk the fuck away. What would you all say are those red flags for founders where it's like, it's enticing where you're like, we're almost at the end of the deal, but you're like, something's off. Where do you find from your own experiences and talking to founders are like those solid red flags where you're like, this is a non-negotiable?
My mind just immediately goes to like my own sales to sing for you, Carrie.
Let's start with you. Let's start with you.
I was like, what can I share there?
Yeah.
Okay.
Let's not get
these are
sued.
people I didn't sell to, so yeah, it's okay. I mean, this sounds like I feel like so trite, but for me, and I think this is true for a lot of small business owners, I want to like the buyer. And like whenever buyers ask me for advice about like how do I buy a company, how do I get a founder to like me, and I'm like, be yourself, be personable, like care about them as a human. Because I had a couple of conversations the second time I went through a sale where I just didn't like the buyer. They were talking down to me. I didn't feel respected in the conversation. And I was like, well, you know what? They can bid and help me get my price up, but I am not selling to them. And that's
Love
your
that.
choice. When you bootstrap your business, you can sell it to whoever you want. So that matters.
Mhm.
Yes.
Two things. One, my first offer that I got was an all cash upfront offer. And my answer on that, on a red flag, is if something seems too good to be true, it's probably too good to be true. So that's first. The second is, I think when you're going through an acquisition, especially if it's one of a certain size, depends on where you go, you know that there are going to be it's not going to be perfect. And many, many times I say to founders and said to myself when things, and I had a pretty good acquisition, in terms of my integration and all of that. I said, you know what? They paid a pretty penny for that. So if they're paying a pretty
Yeah.
penny for it, okay. But if it's not a pretty penny for you, and there's a red flag, if it's just like kind of a rusty penny, kind of a, don't don't ignore red flags. If it's um good, good money that you feel solid you can count on, like forget about the earnout stuff and all that. Like, okay, they're paying a pretty penny. Weigh the red flag against the money and what's important to you.
We love
Yeah,
this.
and picking your battles, I think that's
Yeah,
kind of that's I think that's really good advice, Carrie.
thank you.
Because even like after, no matter how much you love your buyer, they're always going to do things differently than you. You're never going to be 100% happy with how they run the business. It's just impossible because they're different. They're different people, right? So I
Yeah.
think, yeah, picking the battles and knowing when you've won. Like if you've sold for a
Fun,
life-changing amount that
fun,
helps you,
fun.
you've won.
It's
Yeah.
never going to be perfect. It's actually never, ever going to be perfect. I've not spoken to one acquirer or one person who sold who said, this was perfection.
Oh,
Everything was
never.
sunshine and rainbows. Everything worked perfectly. There were no bumps. Like
This
everybody,
is relationships. Like
yeah,
everything I'm thinking of, it's like all
huh,
these people who have their list and then they're like, well, why can't I meet anyone? Because I'm like, that thing does not exist because
yeah,
it doesn't
yeah,
exist. There's
yeah,
going to be some messiness and that's okay. So I
yeah.
love this. So the way I would love to wrap is, everybody that's listening in might be on different paths their journey. Maybe they're just like, this is an FYI. Maybe they're like, now I'm considering it, or they're like, no, I'm actively pursuing it. If you could say for both of you, one thing you want founders to just focus on, if they're serious about, I would like to sell this and get acquired one day, what do you feel is the number one thing that they can work on right now? Or it might be a couple things based on stage. But if there's one thing you're like, this is where you should put your focus. Let's start with you, Lexi.
I'd say just learn about this now, like doing this, listening to this, and absorbing the information, like understanding the levers that make your business valuable. If you do it now, you will absolutely sell for more. Like you almost can't avoid it. If you're educating yourself now, that's the best thing you can do.
Yeah, definitely read, listen, all of it. Another good podcast, Built to Sell, is great. Like there's just learn stories of founders and learn from their mistakes and see. But I would say from a business perspective, it's have a model that shows profitability and then prove that. Like when you're first starting, you're not going to be immediately like making so much money and all of this stuff. I mean, I talk about profit a lot, and sometimes I think it can be tone deaf when you're first starting. Like it's hard. It's hard. But as long as you have the model and you're proving out that you can get to that model and you're showing traction, I think that's really good. The model doesn't have to be perfect from day one. You're not going to make enough to offset kind of what you think the expenses of that model might be initially, but just have a path to get there and show traction to get there is already sort of building to sell.
Amazing. So for the founders listening in, they're like, I either want to work with you or learn more about what you're doing. How can they connect with you? And Carrie, let's start with you, and then Lexi will end with you.
You can find me on LinkedIn or wearethewhispergroup.com. We offer a lot of founder exit readiness coaching. We also do founder-led exits if founders are doing this on their own and need behind-the-scenes coaching, and may eventually expand beyond that. But that's Carrie at wearethewhispergroup.com. Find me on LinkedIn and let's go.
Yeah, and I'm at theygotakquired.com. And I'm also on LinkedIn, or Alexis at theygotakquired.com.